Hey there, Brian Bogner, along with Greg Towner. It's 5 charts in 5 minutes for August 2023. Got a lot to talk about, a lot of good stuff. Let's go ahead and get started. Greg, take it away.
All right, thanks, Brian. Normally we start at the S&P 500 and maybe look at a 3 or 5 year chart. We wanted to zoom out a little bit this month, go all the way back to the bottom of the financial crisis, going back almost 15 years now, amazingly enough. And we look at it's been a huge run higher for stocks. Obviously, there was some corrections and even some minor bear markets along the way, including the brief COVID one. But we've been talking about for a while now that the market needs to kind of digest these gains. Sometimes it takes years to even do that. We think there's a decent chance that the market stays within those black horizontal lines we've drawn. Obviously, we don't know. It could break out to the upside. It could even break to the downside. But our base case is it keeps going sideways. But what we really wanted to point out here is on the very far right, that little blip that we've seen is this correction here this last month. Investors had gotten a little bit ahead of themselves, a little sentiment maybe got a little extreme. Now they're quickly going the other way, getting scared again. But if you look, that little blip, I mean, there's literally dozens of those over the last, decade plus. So those are just a really normal aspect of investing in the market. Don't get caught up in a little day to day. Now, a chart that we really want to focus on here, this is another long-term one going all the way back to the mid-1990s. This is the 10-year U.S. Treasury yield. So, of course, we know yields have been declining for a long time, even going back further than this chart. Really collapsed during COVID, and that whole area kind of distorts a lot of things. The last couple of years, yields climbed quite quickly. People were really negative on bonds. Now, here for the last 9 to 12 months, yields kind of digested things, traded sideways, and now just in the last week or two have broken higher. Now, I mean, we don't know if they're going to keep going higher. They very well, this could be a head fake and could pull back. But the point being, we're now at the highest in 16 years for this 10-year yield, and it's getting people really nervous. I think it has contributed to stocks pulling back some. It makes things more expensive for corporations to reinvest debt. It's more competition for investors. So it is viewed as a negative, but I don't think people should only look at it that way. I mean, if you look into the data, and I know we have a chart coming up here that allows us to say, hey, maybe yields aren't only negative, particularly if investors allow little time to adjust to them. Sometimes, like when you see gasoline at $3 at the pump, the first time you're like, oh my gosh, this is too much. Then you kind of get used to it. Maybe investors need to just get used to higher rates.
And I think along those lines too is that we forget, right? Like if we think about the run up in the market into the tech blow up, right, back in 2000, and that was a tech blow up, right? That wasn't necessarily interest rate related, but interest rates were higher than they are today, and the market went up. So the market can go higher with higher rates. It's just right, like you say, these got to adjust and get used to it and things like that. So there's plenty of history where the markets has held well or done well under these type of rates.
Absolutely. And here is some of that history. At the top here is the S&P 500. At the bottom is the 10-year yield again. This goes all the way back to the 1960s. Those red lines are each time that the 10-year yield broke out to a new 10-year high. So it's only done it 7 times until just recently. So not a lot of history, but historically, when it has done that, 2 months later, the S&P was up about 6%. A year later, it was up 11%. Now, this isn't enough statistically to say, hey, that's what it's going to do again. I think it's just enough to kind of push back on higher yields are definitely a negative for stocks. We understand that argument, but I think you got to be careful thinking about things only one direction.
And then you got to put back another layer and say, well, higher yields sometimes are negative for certain kinds of companies and certain kinds of stocks, and not necessarily throw them all in one bag and say, well, all of them as well. So, yeah.
Let's move on to one of our favorite subjects, the behavioral side of things. This is a study done by Morningstar recently. They called it Mind the Gap. A lot of data on this page. We're only going to focus on one number today. 1.7%, negative 1.7%, I should say. That's the amount that investors underperformed per year for the last 10 years, the actual investments that they are in. We've talked about various studies similar to this over the years, and most investors do not actually get the returns that they're invested in, even if it's like a passive index fund, because they're going in and out, they're getting scared, they're getting excited. So on average, nearly 2% per year, they're underperforming. That really compounds over time. So the behavioral side of things, just it never ends in importance.
Right.
More evidence of, what we were talking about in that first chart, all the tiny little blips and, focusing on the longer term. This column, each of these columns look at different time periods for the S&P 500 and what percentage of the time you were positive over that time period. So 1 month, the S&P was up 63% of the time. 1 year, it was up 75% of the time the S&P was positive. 5 years, it was up almost 90% of the time. Now, as you go out to like 15 years plus, you're up 100% of the time invested in the S&P 500. So time frame, sticking with your discipline, with your philosophy, not letting all those little blips, eat at you mentally and cause you to do irrational things.
Right. So in closing, like while we know that the interest rates are moving higher, stocks are consolidating after many, many, many years of gains. We like to say the markets are normalizing, right? Like the 10 years actually getting to a healthy rate. Okay. Having a 10-year yield at 0% or 1% or negative, while that might be nice and in the short term, it's like eating sugar. Okay. It's good, tastes great, but it's not good for you. So having a 10-year yield here is good. But we've been saying this for a long time. While these markets start to normalize, there will be some disruptions and things like that here, but we're kind of coming back to normal, right? Last 10 to 15 years was not the normal. So that's what is happening. Don't allow this short-term noise to alter your long-term investment plan. I know the headlines look horrible. I know the things look, you can look at a million things out there and say, oh my goodness, oh my goodness. But again, we've got a lot of history on our side here, saying that you want to stay involved, invested, and keeping that long-term approach. So as always, you know where to reach us. Thanks so much for watching today, and we really appreciate you. Have a good rest of your day, and we will see you here in a couple weeks.